Hello, I'm Professor Brian Boucher. Welcome back. We're going to close out the week by taking a look at the long-term debt and the leases of the 3M company. Let's get started.
Okay, so we'll start our look on the balance sheet for 3M. And if we go into liabilities, we can see long-term debt, about $5 billion. There's short-term borrowings and current portion of long-term debt, which is another billion or so. So if you add this together, that's about $6 billion of debt, either long-term or short-term, which is not that high compared to the stockholders' equity of 3M. So 3M has about $18 billion of stockholders' equity. So you're looking at a long-term debt to equity ratio of about a third, which is fairly low, which again indicates the fact that 3M's in a pretty good financial state, fairly conservative in how they're managing their business. They're not taking on a lot of debt. Now, in terms of the leases, we're not going to see any of the operating leases here because, of course, those are going to be off balance sheet. But we will see some evidence of capital leases in a little bit. Next, we could take a look at 3M's statement of cash flows. And to see the action with debt, long-term debt, we would go down to cash from financing activities. So we have change in short-term debt, which is a pretty small number. And then here is repayment of debt and proceeds from debt, maturity greater than 90 days. So these would be the long-term debt instruments that 3M has. And as what you can see is for most of the cases we have here, 3M is actually paying back more debt than they're borrowing. Only in the most recent year, 2012, do we see that they borrowed more than they pay back. So again, some evidence that they're not relying a lot on debt financing recently. Most of how they've been financing their operations, as we saw earlier in the course, was this tremendously high $5 billion of cash they generate from operating the company. So this is probably debt related to specific long-term projects because by and large, they can mostly finance their business with the cash from operating activities. So we go to footnote 9, where 3M details its long-term debt and short-term borrowings. They have a table where they have all of their major debt issuances listed. All the smaller ones are combined into other borrowings. So their biggest one is a euro bond with a principal amount of 775 euros. So it tells you the currency is euro, fixed interest rate, the effective rate, so that was the interest rate in play when it was issued, the maturity date, so it's 2 years, and the balance. Now the balance is bigger than the principal in this case because the principal is in euros and it's translated into dollars. So let's look at one that's in dollars. There's a medium-term note with a $1 billion principal amount. So a note is sort of like a bond, still pays coupon payments, but not as long-term. US dollar fixed interest rate means the interest rate doesn't change over the life of the bond. We've got the effective rate. And notice that the balance is increasing between 2011 and 2012. And it's at a point where it's below the principal amount. So what that tells you is that this note was issued at a discount. So it was issued where the effective interest rate, the market rate, was above the coupon rate. And so the market paid less than $1 billion. The proceeds were a discount. And so what's been happening is every year, the balance has been increasing towards 1 billion, which is where it's going to get in 2016. And we can see that with this medium-term note that's 850 million, that the balance has increased up to 850 million. And sure enough, it's due in 2013. So the discount has been eliminated through that interest expense and cash journal entry that we do where we plug bonds payable. And so now we're getting to the point where it's maturing and the balance is at 850, which is the principal amount. And so you can go down and look at the different debt issuances that are summarized here. All the long-term debt that comes due in the next year is summarized in the current portion of long-term debt, and then the rest of it will go into the long-term debt section of the balance sheet. And then down below, there's some more information on short-term borrowings, weighted average borrowing rates. So it's about 3.91% short term, 3.16% long term. Maturity, so debt is coming due in the next few years. How much are they going to have to pay? And then various other information on their debt portfolio.
So I'll be honest with you here. I typically do not spend a lot of time looking at this footnote. The information here is a lot more relevant to corporate finance issues, so how the company is managing its capital structure through borrowing activities. And my bias is always trying to use accounting information to assess managers' performance in operating the company, not in financing it. But if you are interested in those issues, I would strongly suggest our Coursera course on corporate finance, an introduction to corporate finance, where you can dig into these issues more than I can as someone who's not a finance guy and not terribly interested in debt financing. Sorry.
So to find information on operating leases, we need to go to a footnote called Commitments and Contingencies. And this is where you would find it in any annual report. There's always a note on contingencies. These are things that are sort of like liabilities. They're contractual obligations, but they haven't met the definition of a liability, and so they're not on the balance sheet. And so here's where 3M reports their operating leases. So we can see their rent expense was about $300 million in 2012, just to give you a sense for how much of their income and cash flow is going towards renting property, plant, and equipment. But what we're really interested in is trying to figure out how big these operating leases would be if they would be on the balance sheet. And we can see down here is a disclosure of all of the expected cash payments they're going to make on these leases from 2013 going to 2017 and beyond. And notice the operating leases, the cash flow payments are much bigger than the capital leases. I don't know if you remember this the last time we looked at property, plant, and equipment, but capital leases for 3M are not that big. I think it's about $100 million or so that they have on the balance sheet. But operating leases, it's a lot more that they're keeping off balance sheet. And this is something where last week we were speculating part of the reason why 3M didn't seem to have a lot of property, plant, equipment or a lot of depreciation could be these operating leases. So what we're going to try now is to estimate how big these operating leases would be if they were actually put on the balance sheet as assets and liabilities. Okay, so I'm going to pop into Excel and we're going to try to figure out the present value of these operating lease cash flows, because the present value of those cash flows is one way that we can estimate what the liability would be if these were on the balance sheet. So I've copied over the future cash flows into these Excel cells, these cells in Excel, and we just are going to take the present value. Now, one issue we have is we've got this after 2017. Now, it's hard to take the present value of something that's that amorphous, so we're going to have to make an assumption. So what we're going to do is carry over these payments, but for the after 2017, I'm going to split it up into two payments after that, just to make the present value easier. So I'm going to assume that this is the way the trend is going, that there's going to be two more payments, one of 60 and one of 59. You could split it into three if you want to do it more complicated, but you're going to get sort of the same answer. Now that we have the payment stream, what we can do is go ahead and calculate the present values. And so what I've done here is I've set up a formula for each. And up here, I've got an interest rate of 3.5%. I got that from, if you remember a few minutes ago, we saw the weighted average effective interest rate was about 3.5%. So that's what I'm going to use for these leases. And then I created a formula. Let me bring up what it looks like, where I linked to that cell. So it puts in the interest rate. Of course, I could have just typed it in as well. For the number of periods that we're discounting the cash flow back, I've taken the year, so 2013 minus 2012, so I'm discounting it back 1 year. There's no payment, but instead we're just discounting back this future cash flow of 194 to present value terms, and it would be 187. Then I do the formula for the next year, which is the same except now it's D13, so it's discounting this payment back 2 years. So we're discounting 158 back 2 years, and so forth. So if you go all the way down to 2019, the way the formula looks is we use this interest rate of 3.5%. We discount it back 7 years, 2019 minus 2012. This payment 7 years from now, $59. In present value terms, that's $46. Then I can add that up, and I would see that the present value is 6.62. So that's one estimate of what the liability would be if this was on the balance sheet. And then the cool thing about setting up the formula is I could play around with the rate. So one thing I noticed is 3M recently took out a medium-term note with about this maturity, and the interest rate they got was 1.5%. And so I could type that in, and it would change the present value up to 735. Now, the other way I said you could do this is you could take 8 times rent expense. So we saw in the disclosure that rent expense was $300. If we take 8 times that, we get $2.4 billion. So what's the liability going to be? Somewhere between $735 million and $2.4 billion.
So a good question is, how can something like 8 times rent expense be even close to as accurate as doing the present value of all of these future lease payments? Because something like the 8 times rent expense assumes that it's about 3% over 8 years, so it's a very coarse estimate. But the problem with the present value calculation that we did is if you look at the payments, they start at 194 and then they drop substantially. Meanwhile, 3M has been paying about $300 or so a year in rent expense. So what's missing from this from the table of payments is that these leases are expiring, and so the payments go away. But if 3M still needs the equipment, they still need the buildings, they're going to have to renew the leases. So really, this is a bit misleading because it's showing these leases go away, when in fact 3M would probably have to renew these leases going forward. And that's why something like an 8 times rent expense, which assumes a constant payment, may actually give you a better guesstimate of the amount than the present value approach, although we could look at both and split the difference.
So anyway, let's just split the difference and say that there's about 1.5 billion of both assets and liabilities that 3M keeps off the balance sheet through its use of operating leases. So how big of a deal is this? Well, if we remember from the balance sheet, or at least I remember from the balance sheet, net property, plant, and equipment was about $8 billion, and long-term debt was about $6 billion. So if we added what we see here for the operating leases, net property, plant, and equipment would increase to $9.5 billion, and long-term debt would increase to $7.5 billion. Now, still relative to stockholders' equity of $18 billion, this would not dramatically increase the leverage ratio, but it does increase it, and is a pretty sizable number. So if I was going to compare 3M to other companies, what I might want to do is some kind of quick and dirty adjustment to get these operating leases back on the balance sheet so I could get an apples to apples comparison to the other companies if I was going to do any kind of ratios. So, it's not as enormous as these operating leases can be for some companies, but it is still a big deal that's kept off the balance sheet for 3M.
And that wraps up our look at time value money, long-term debt, and leases. Thanks for sticking with me through a lot of minutes of video this week. Don't worry, next week we're going to move on to a lighter, happier topic, taxes. I'll see you then.